Hello traders, in this video I'm going to explain to you why I believe your equity curve is meant to go consistently down most of the time, and why your equity curve looking that way is actually a good thing. Stay tuned for that, because in this video I'm really going to try and dive deep and explain to you guys some psychological aspects that go into trading that can really help you to improve your mindset about your trading. And I think it's normal that your equity curve looks like this right here. It looks like sort of a line sort of sideways down, and every now and then you get a big boost to the upside. That's the way I think it should look. But in order to make it look that way, you need to do a few things. Obviously, this is not going to be applied to every single style of trading. There's many different ways to skin a cat. I'm just giving you guys my own experience here, and I'm more of a swing trader. My name is Chris, and I own this VerrilloTrading channel here, and I'm going to give you guys here a video that I think is going to help some new traders get across some of the psychological hurdles involved with trading. And the reason why you guys have to deal with a lot of these psychological issues is because a lot of people on the internet, you watch content of people cherry picking their best trades, and they show these high win rates, and it kind of messes up your entire outlook about what you're expecting from trading. So in this video, I'm going to go into some of the reality of really what I think trading is all about and some of my experiences. Now, it just sort of happened that today I hit a really big trade on crude oil, and honestly, I was going to film this video whether I hit the trade or not. If I didn't hit the trade, my activity log was going to look something like this, where I had multiple losing trades over the course of multiple days here. As you can see here, it's since I guess the last couple weeks of July going into early August here, and I had a lot of these small losing trades, but today I hit the trade that I was looking for, and it just so happened that way. So I don't want to make it look like I'm cherry picking the trade, but it so happened that on the day that I filmed the video, I actually hit the trade. And what this is going to be a lesson for you guys, and I want to explain to you something especially regarding position trading and the art of sort of stalking a trade and taking paper cuts. Now, I used to be more into scalping, but lately in the last year I shifted more into position trading because I find it fits more with my overall schedule. So all of this nonsense over here that occurred, all these little trades of taking small chopping trades, most of the time I was looking for an entry where I could hold on to something to land a bigger movement of the market. And what that means is that most of the time when you're doing that, you're going to be taking losses. You're going to be getting stopped out or taking break evens or just putting on risk. You're paying to play the game, just like you would at a poker table. There's a big similarity that you can make to trading in poker, which is, the longest person to sit at the table usually is the one that's making the money, because they can sit there and read other people's actions, and they can basically get a better glimpse into the game, how the game is being played. So the mistake that a lot of traders make is that they take 3, 4, 5 losses in a row, and then they quit and they stop looking at the market. They get discouraged. But if you're trading in this style, which is a style of where I'm going for more bigger picture moves, like I'm looking more at 15-minute and daily time frame as well as weekly time frame, for example, and I'm picking out these supply demand zones that I know historically the market is likely to see a reaction and kind of pivot off of. And, I'm not going to go into all those specifics, but I'm just explaining to you the basic concept. So I have the stuff that I look for, right? But in order for me to land those trades, in order for me to hit the trade, and I'm speaking in hindsight, obviously I did end up hitting the trade, but it could have just so happened that I didn't hit the trade. But it is helpful that I did hit the trade, because it kind of confirms a bit about what I'm saying here. You have to continue to sit at the table and monitor what the market is doing for your setups. So you have a specific setup that you're looking for in the market. You have to be able to accept multiple paper cuts before you land that one trade. I think it's a huge concept that can separate a beginner trader mindset from a more experienced trader mindset. So a beginner trader mindset would be like, you show up, you take a couple trades, you lose a bit of money, and you give up and you stop. And then maybe you look at the market later and you do the same exact thing. Your plan is too bare bones most of the time. You're looking at the market on an intraday basis. You're not considering market sentiment. You're not considering news articles, news releases that are coming out. You're not considering bigger picture supply demand zones in your trading. The beginner trader is, in general, I would say, missing a lot of context into what's really going on in the market. And then second of all, they have the wrong mindset about trading, because they haven't really grown the balls yet to be able to sit through some chop in their equity curve. Now let's talk about the equity curve real quickly. So I did a little poll here on YouTube 2 weeks ago from now, where I asked people, which equity curve do you think more accurately represents your trading? Out of 142 votes, which is not a lot, 96 of you said that your equity curve looks more like this, which is long periods of chop, sideways, slowly down action, followed by 1 or 2 trading days or 1 or 2 trades that kind of grow your account like that. Whereas about 50 of you said that your equity curve looks more like this, consistently higher, which I honestly think that this is not a reality right here. And maybe some of you guys were just trolling or whatever, but I want to explain to you kind of different scenarios. So your equity curve is going to be different depending on your trading style. For example, if you have a higher win rate, I know a trader that has a higher win rate and he trades small caps on the short side almost exclusively. And most of the trading days where he trades, he's making some money. Just because his strategy is a higher win rate strategy. He's not really looking so much for risk reward, but he's looking for a particular setup, and typically that setup wins on the average day. Whereas most other traders, guys trading futures, looking for setups, bigger picture plays, weekly time frame, daily time frame, or maybe even intraday too, your equity curve, I'm going to say, looks more like this. And the reason why it looks more like this, there's multiple different reasons. I want to go into some of those reasons right here. So the first thing is that as a beginner trader, when you're dealing with an equity curve that looks like this, it's kind of really demoralizing, because you look at it, you look at your account, because obviously you just opened your account, it's a year or two that you're trading, and you're seeing your account go down like this. You're like, whoa, this is a lot harder than I thought. Why am I not making money? I'm seeing all these guys on YouTube that cherry pick these trades. They have these high win rates. They're making these big flashy numbers. But why does my equity curve look like this? It doesn't add up. I'm going to say that it's 100% normal for your equity curve to look like this, especially if you are a bigger picture position trader. Now, if you learn how to play the game, typically what should happen is your equity curve looks like this, followed by 1 or 2 trades that shoot it back up like that and make up for all this crap, all this nonsense right here. And this is exactly what happened to me here. And it's happened to me last year as well. This is a common occurrence, and I've also seen this with other traders that I follow. One of my trading inspirations is a trader named Fat Cat. You should watch his YouTube channel. He has very good content. I think that his trading looks a little bit like this too, because when you look at his P&Ls that he posts and he goes through his trades, it'll look something like that, where you have multiple trades of chop, a win, a loss, chop, 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 and then you have one trade that he was scouting that he finally hit the trade, and he got it to ride a little bit, and he got some money on the table with that. You know what I'm saying? So this is actually a perfectly normal thing. Now, the mistake that new traders make, and inexperienced, I'm not just saying absolute beginners, I'm saying even traders that have been in the game for a couple of years, is that you're not used to this. You're not really enough used to this. And maybe you don't even have enough experience in a variable income business to be able to even psychologically accept this. So you need to build that up. You need to learn what struggling is all about before you can sit around the table long enough, learn to sit around the table long enough so you can not hesitate to continue hitting it till you hit the trade that shoots your equity curve up like that. Now, again, I'm just giving you one perspective on this. There's different ways to look at this, and there's also another reason why I think the equity curve looks that way, and it's because of market cycles and the seasonality of markets, but we'll get to that. I'm just going to talk a bit about the psychological impacts of different equity curves. So, like I said, when you're a non-experienced trader, that type of equity curve where you're chopping slightly down like this is going to make you frustrated. You're going to look at that and you're going to say, I'm losing. Why am I not making money? So that might induce even worse behavior on your part. You're coming back day after day and you're losing a bit of money and you don't really know why. And then eventually you reach a day where you don't know how to deal with your frustration, and it finally catches up to you. And then you end up doing this, where you put on too much risk, and this is typically what happens. That's the problem right here. So I want to just be clear. This is not the problem. The problem is when you start doing this and then this. That's the problem. And I think that that's the part that's really psychologically damaging, and obviously account financially damaging, that you really can't make back. Well, you could make it back, but it's going to be a lot more work to make it back. You know what I mean? That's why I think when it comes to the psychological impact of how your trading affects you, in my opinion, it's better to create a plan of trading where you're taking small risks rather than taking larger risks. And of course, you're going to find a lot of people on YouTube that might say the opposite. I'm just explaining to you one perspective, which is that I think it is more psychologically beneficial and easier to deal with in the long run and easier to maintain a longer sustainable trading career if you learn how to, number one, trade around the market seasonalities and market cycles, which is important. We're going to talk about that more. And number two, which is take smaller risks, but set yourself up for if the trade rides, it can pay you and make up for all that nonsense where your equity curve is going slowly down. So one of the main mistakes here that I think is so important to highlight regarding this is that it's important to sit at the poker table for pretty long. It's a good analogy to make to poker. If you go to the casino and look at the poker table, normally there's a few people there that are there the longest, and those are the ones that are like the sharks that are taking money from the average person showing up. I think that in order to be around for the good trades, you need to be able to sit around the poker table and constantly be monitoring the market for your setup when it's there. And at the same time, when there's no setup, you also need to be able to go away and step away from the table immediately. If the market is slow, go on vacation, my friends. And if something that you're doing is not working, you need to also step away to analyze the situation from a different perspective. Maybe come back the next day and look at it in a different way. But at the end of the day, in order to be there when the setup is there and hit the trade, you need to be monitoring it, which means that if you're monitoring for a setup, and you're taking a couple of paper cuts, and I guess I should show you some of my paper cuts from the last couple of days here. I trade micro crude oil. You can see here, before I entered this trade the prior night here, I was trading in the overnight session, I took a couple paper cuts. So this was the first entry right here. Exited for a small loss because I didn't like what he was doing. We were holding above the daily level there, the daily supply demand zone. I took another entry as we tried to reclaim that. I also got sort of stuck right there. I took another small loss right there. Then I waited. I saw that the market had come up, traded against a weekly supply demand zone, and then started to fade down. And I realized that later in the evening. And that's why I finally decided to re-enter the trade again. And I was willing to add more if it was going to continue to work. So I did add more here on this pullback, as I saw that when I got in, it initially worked. Now, if I was able to stay up all night and continue to trade this, maybe I would have added even more and continue to add as it went in my favor. Going into how this psychologically impacts you, well, I'm taking a small loss here. So the mistake that new traders would make is that they take these paper cuts and you're like, all right, I'm done. I got to go play some World of Warcraft. I got to go out and go see my friend. I got to go do something else. That's some biggest error. You cannot do that. When you're scouting a setup and the setup is there, you need to solidify this in your trading plan, how many times you're willing to hit the trade, how much capital you have allocated for taking paper cuts and, getting into the trade. And you just simply can't take 3 paper cuts on a setup you're scouting and then not hit it again after that. That's the biggest mistake. So you're not allocating enough capital. Your trading plan is not concrete, solidified enough that you know exactly what you're doing and how you're going to react if you get stopped out, if you take 3 paper cuts, 4 or 5 paper cuts in a row. Are you going to hit it the same way again when the setup is still valid? And obviously the market is always in control. You can't control what the market does, but the market gives you a lot of information. When the trade is working, that tells you one thing. When the trade is not working, it tells you something else. The lesson behind this is what's very, very important. And it's that a lot of new traders, you're not ready enough. You haven't developed that iron mindset and that solidified trading plan to be able to hit the trade without hesitation every single time that it is there. Do you guys understand where I'm coming from? Comment below if you know what I'm talking about. If you don't agree, also comment below, okay? Every style of trading is a little bit different. I'm just showing you my perspective, okay? So I personally think that this type of P&L is something absolutely normal for most position traders. It's a very low win rate, but when you hit the trade, you hit it. So most of the time, you're going to be struggling. I think you should be struggling. You need to be struggling to be getting better. When you're not struggling, you're not getting better, in my opinion. You should be learning. You should be struggling. You should be struggling to get into these trades. And like I said earlier, I also think that this type of trading has a better impact on your psychology over the long run rather than having the opposite where you had, let's say it was the opposite, where you had small win, small win, small win, and then big loss. And I'd look at all this and be like, what the hell was the point of all this work right here? I was just wasting my time getting all these small wins, and then all it took was this to, lose it all. Whereas if you're on the other side of this, small loss, small loss, small loss, but then big win, all of a sudden you come out and now you're a big muscle man, right? Because your psychology is in a better place when your P&L curve looks like this. Now, I'm not saying this is the absolute proper way. I'm just saying that it's probably going to be less harmful to you in the long run to trade this way rather than trading in the other way where when you lose big, and when you win small or okay. If you look at your P&L and you're seeing that you had one trade that wipes out 7 winners, you are going to be psychologically impacted by that. And most people are going to be pretty negatively impacted by that, even if you've got balls of steel, my friend, like Duke Nukem. So the last thing I want to talk about in this video here is market seasonalities. So another reason why I believe that your equity curve most of the time looks like this is because the markets don't go in a straight line all the time, and there's seasonalities for how they operate. For example, about 1 year ago, I was also trading crude oil because I find, for whatever reason, crude oil, I noticed that it trades in some sort of these 6-month cyclical seasonal patterns. Now, it might just be a pattern I just identified. It might be completely arbitrary, but it's something that I noticed. So we'll go over to the chart right here, left screen. And if you look over at the, say, like weekly chart, so I'll do 1 week and we'll wait for this to load here because that's the load continuous contract data. So if we look at crude oil from a seasonal standpoint here, let's start from the beginning of this. So we have December of 2022 until halfway through the year. You can see that crude oil moved up. Okay, so we have that upward rotation. It lasted about 6 months long. Now, just out of coincidence, from June of 2022 until the end of the year, we had a 6-month rotation down. So the next thing is from January 2023 until halfway through the year, June, what I noticed that the market is now moving completely sideways. So we have one rotation up for 6 months, one rotation down for 6 months, and then one rotation sideways for 6 months. So what does that tell you going forward? Well, what I thought about the market here going in June, and if you guys go and cherry pick my Telegram posts in my Telegram group, you guys can join. It's completely free. You'll find that I was probably looking bullish on crude oil here. Now, I didn't trade it. Even if the market is in a bigger picture rotation up, potentially, now you can see here we're multiple green weeks in a row, I do still think that a lot of the intraday opportunities can be from the short side. And that's kind of interesting, and that might be hard for new traders to conceptualize. They'll hear me say that and I'll be like, wait a minute, you think the market's going up, so why are you going to short it? Isn't that going against your initial plan? What I mean is that the market is going up on a bigger time frame, but the opportunities intraday, depending on where the market opens and how it's positioned and what kind of levels we're trading into, those opportunities, the best ones typically are on the short side. And if you look carefully, if you analyze the price action over the last couple of weeks in crude oil, you'll find that even if the market has been going up, a lot of the best opportunities have been from the short side. And I do expect this to potentially continue going forward. So the whole point about cyclicality and seasonality of markets is that the market is not always hot. The market is not always going up in a straight line. And what that means is that if you're trading only 1 or 2 or 3 markets, you're going to experience periods where you're not making any money trading, or you're making only barely anything to survive. And you certainly will not be able to survive on that. And I think this is important to understand because it can reduce some of the psychological pressures that you might experience from trading, because you might have 2 or 3 months in your trading where you're saying, well, I'm not making any money. Is this really worth it? What am I doing? I'm wasting so much time doing this. But you need to understand that the markets are designed this way. The markets are designed in a way that, for whatever reason, I've noticed that the majority of money is made in the shortest amount of time. Unless you're doing long-term investing, that's something completely different. I'm talking about trading right now. And most of the time your P&L is chopping, and most of the time you're struggling, and you're struggling to eventually hit those trades that are going to make up for all those struggles. At the end of the day, it is human beings that decide where to throw money and when to throw money at the market. And what this means is that there's not a constant flow of money being thrown at the market every single day, every single month. The majority of time, the markets are probably doing nothing. And during the times where it is doing something, you need to be absolutely ready to take some paper cuts to hit the trade that you want to hit. In that trade, normally, if you got a bit of luck in your favor and you sat there long enough and waited for it and hit the trade without hesitation, you're eventually going to get something to run. And that trade can potentially make up for everything in the last couple of months where you were doing nothing. I want you to go ahead and ask any profitable trader you know. You might not know a lot of them because everyone's a fucking cherry picker on YouTube. But if you do have the pleasure of knowing a trader personally that is consistently profitable, trading their own money, not fucking combined funded accounts, go ahead and ask them what their equity curve looks like. Go ahead and ask them what they think of the stuff that I'm saying in this video. And maybe that will help confirm your existing bias. Maybe it'll help improve your psychological outlook on your trading, what you can expect from your trading and what not to expect. So let's go ahead now. I'm going to show you an example of the trade that I took. I guess we'll start here at the weekly time frame. So I draw supply and demand zones kind of like this. And people do it differently. This is just my way of doing it. So I use something called one-time framing, which is when you have multiple bars closing in the same direction, and then you have a test of the previous bar's high against the direction of the one-time framing. So in this case right here, 3 bars down, and then you had this bar which tried to break higher and tried to break the one-time framing of this 3-bar down pattern. So that's where I mark the weekly supply level. I'm looking at a crude oil continuous contract here, but I actually look at both of them. For example, I have the U month as well as the V month. So the front month and the back month. Normally the levels are pretty similar, but I keep them both there because they're both contextual. In this case, I was looking at the V month, but it doesn't matter. I'll go over the U month, right? So here's an example of another weekly supply zone that I plotted there, 79.37, which is you had 1, 2, 3, 4 bars closing higher than the next. And then the first time we closed below the low of the bar was right there. The weekly level goes right there. Sometimes in Sierra chart, my lines get moved a couple days back. I have to look at that. So you can see that's where I put the weekly supply zone. Now, some of you are going to say, well, that's arbitrary. Why do you put the levels there? How do you know they work? All that. Well, I know they work because I've been watching them for a really long time, and this is the way that I do things. And I've seen it occur in multiple markets, and I just see them work, right? I'm not trying to prove to you that this is the ultimate method, that this is the way to make money. I'm not selling you guys any method or any strategy. I'm just explaining to you that this is the way that I do things, and it works for me. So I'll do the same on the daily chart. So I'll go to the 1-day time frame now. Here's an example of the daily time frame now. This 80.59 is a brand new level because it's the first time that we're closing below the low of a bar when we have multiple bars up or one time framing up. So what we had going into this trade that I hit is a market that traded up into a weekly supply zone as well as a daily supply zone simultaneously. And I was watching that very clearly here. I was also watching this one earlier in the week or last week, and I may have taken a couple paper cuts on that. But notice how I wasn't willing to stay short. Like, I'm not going to stay short if my levels are not working. I'm not going to sit there in the trade hoping it's going to reclaim the level and the market continues to go against you. That's how you end up with those big losses, right? And I don't wish that upon anybody, but I'm just explaining to you the concept of how I use some of these levels for managing my risk control. So for example, if we're consolidating above one of the levels and then it ticks it on the bottom end and then holds it, that's kind of a negative signal, and I really don't want to be holding the trade short anymore at that point. But if we see the opposite, which is what we saw last night, which is where the market's moving up and we're consolidating around that area and we're kind of holding it, we're ticking back and forth, that sort of gets me interested in the short side on the trade. And then when I go over to the 15-minute time frame here, and I know my 15-minute chart's going to look like a big mess for you guys, but just keep an eye on it. So the CLU chart, I was watching this market yesterday here. So this is a 15-minute chart. Some of the levels might not be valid anymore, but most of them still are, I think. You can see here right on the close of Globex, or the close of the electronic market, the market moved right into that daily chart level. And as soon as I saw that, I was alerted because I had an alert at the level, and I was immediately scouting it. So I was actually pretty aggressive. As soon as Globex opened, I shorted it right away. And that's where I took a paper cut. As it moved down and then moved back up, I said, okay, it's holding it. I'm going to get out right now and see what it does because it's overnight trading from 6 p.m. until 9 p.m. Eastern, which is that time period before the Asian market open. Typically the market's slow, so I wasn't really going to be sitting there waiting for it to do anything. So yeah, that was the first entry right there. You can see it was kind of right on the open of Globex, and then I stayed in that actually for quite a while. And then I finally decided to get out. Once I saw it bottom ticked the daily level and held it, I actually cut the trade right there. So notice I waited for a period of context. I waited for market context because this could happen too, where you have a stop run at the highs, consolidate, 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 and then it reclaims it and continues. And in that case, that would have been one setup. But in this case, what we saw is it bottom ticked the level and held. And I was like, am I really willing to hold that? I'm going to get out and wait. Then I re-entered here on a sell stop as it reclaimed that area, and I got stuck. And that happens, right? That's the type of thing that happens. You have to be able to accept this. I see a lot of traders sometimes where they get sort of top ticked or bottom ticked on an entry or on an exit, and they get discouraged about that. Like, oh, I got the top tick. Oh, I got the bottom tick. Like, really, in the grand scheme of things, for my trading, it doesn't really matter that I got into this nearly at the bottom of the move. It can absolutely happen. You have to be ready for it to happen. So I'm shorting this on a reclaim of a daily supply zone. And one possibility is that it reclaims it and it does not look back. Another possibility is that it bottom ticks a level, gets me in, and then stops me out right away and reverses. Another possibility is it stop runs the level by a few ticks, comes back, reclaims it, chops, holds it, and then goes up. There's many different things that can happen. In this case, I waited to see what would happen. I got stopped out. Again, it's just a feeler. I'm putting on a feeler to see, how the trade is going to react. Because at the end of the day, I don't know what the market's doing. I don't know which Saudi Arabian prince is going to come in and sell 1,000 barrels. I don't know who's going to be trading this thing. All I know is my plan, my levels that I work around, and how much risk I have to allocate. So I waited around after that. I took the small loss. And then came back a little later and I saw something interesting. What I saw was the market moved up into this weekly level, which is kind of a hidden weekly supply zone. And you saw me mark it on the chart earlier. And you can see right there that the market moved into that and then was supplied from that zone, resupplied right there from that weekly time frame. And according to my way of doing things, it would have created a new 15-minute supply zone right there as well at 82.37, which would be aligning directly up with that weekly time frame. So basically what we had is a test, an attempt to reclaim a weekly supply zone, and a failure and resupply down. That got me interested in the short. So for whatever reason, I saw the market going down here and I put on the feeler and it worked right away. And we're going down to the daily chart level now here. And we're chopping around that daily chart level, which is 82.11. A daily chart supply zone, the same one that I showed you earlier. And at this point, it's getting late at night and I'm doing other work. I'm programming something, whatever, busy. And I'm looking at the market and it's chopping. So I'm saying, all right, I have my stop above the highs. My stop was actually about 82.55 on that trade, which is basically going to be hit if that weekly level gets invalidated again. So I'm basically putting a bet that the high is in, which is kind of a... Normally, you're going to lose doing that. But every now and then, if you're right, you're going to hit one. And that's what happened in this case. But I'm playing it on bigger context. You guys have to see that too. We have a daily level. I'm looking for it to reclaim that level. We have a weekly level up there. And it's kind of a hidden weekly level because it's not in plain sight, but it's something that it's there. And not all traders can see it, but it is there. So basically, once that market traded on the weekly level, I put on some here as it was selling off. Around 11 o'clock in the evening, and the trade worked immediately. So that was a good sign. I wanted to put more on. What I noticed here is I put the first order in, got filled, and I actually hit the bid to get into this one. And I put the second order in a couple ticks lower after I'd been filled, and I wasn't getting filled, and the market continued lower at that point. And then it continued towards this daily chart level where it consolidated for quite a while after that. And I should be on a 1 minute chart here. Let me switch over to that 1 minute. My stops are above the highs at 82.55 here because, I don't really want to be in the trade if it's invalidating that weekly level again. Personally, I think that if it would invalidate that after doing what it did, I think it could really result in the trade going the opposite way, like higher up into those 83s and about 83.50, I think it was. But if the weekly level stayed in play and the way it top ticked that and the way it tried to go through and held it and resupplied the weekly level, I think that if it would invalidate that again, I don't want to be short. But if it stays the way it is here, I'll gladly stay short. So I started getting short, got filled on my second order a little bit later here as it pumped through the range. Stops in the same area. And then by this time, I pretty much went to bed, but I was watching how it was trading. And it still looked heavy. Like I noticed it was going up and down a bit, but it looked pretty heavy based on how it was trading. I found every time the sellers hit the tape, they knocked it down 2, 3, 4 ticks every time. So I found it a little heavy. Anyways, what happens overnight and what happens in the morning is typically two different things. So in this case, I went to sleep. I slept pretty good, honestly. And then I woke up this morning and the market is basically doing this. The market's basically down here at that point. So the trade had worked. And so I just started turning on my computer, and we had this previous day VWAP close. It may have bounced there, but I'm not so sure. Either way, by the time I got up, it was already down here. It had already bounced from this 80.42 area. Then we had the crude oil inventory report at 10:30 a.m., which I was well aware of. The thing pumped up on the inventory report and then continued to sell off. And I'm looking for profit targets now, kind of in a few different areas. So we had this daily level here, one level of context I was watching, which was 80.59. That was a daily chart level. And it held it initially here on the inventory report. And then after that, it reclaimed it and started reclaiming and started continuing to sell off. And it took its time. The key with crude oil when you're watching it intraday is you can't get too distracted by the short-term noisy price action. Because there's a lot of it. There's a lot of it where it'll sell off 5, 6, 7 ticks in like a microsecond, and then it'll immediately fly up 10 ticks or 7, 5 ticks, you know, making it seem like, oh, you missed it or whatever, it's gonna go the other way. That's just how it moves, you know? So you have to learn and practice the skill of learning how to read the order flow, but not get too caught into those little sweeps that it does for 5, 6, 7 ticks, because the bids and offers can pull very easily in crude oil. So the market continued to sell off, and it was selling off very, very fast and very aggressively. So the more fast and the more aggressively the market is moving in my direction, it makes me want to get out faster, because it also means that, because typically that means that it could bounce really hard if it's moving really fast into certain areas. So basically my first target was at 80 bucks, right around $80 even, because, you know, it's a big even number, a psychological number, and sometimes it'll come 2 ticks shy of that, or maybe right on it and bounce right on it. So my first target was right there, and that was my first contract. That was short 2 micro contracts. So I got filled on that first contract at 80.03, and I was willing to let the last one ride, see how far it would go, you know, give it a little bit more room. So as the market was selling off here, again, we're on this 1 minute chart. You can see that was my first target fill right over here, 80.03. Bounced from that for another minute or so, and then we went for another new low right here, and we're 10:42 in the morning here at this point. We have a big sweep down. I mean, I moved my order lower, and I got filled at 79.69. The reason I put the order there, if you look closely at the levels right here, we have 2 15-minute demand zones right here. One at 79.63, the other at 79.69 right there. And there's a weekly level at 79.37, which I wasn't so sure we were going to go to. And judging based on how in the money I was already on this trade, I don't really need to be sitting around trying to get, you know, 30 more ticks on this. It's not really the end of the world. So I'm willing to cover it as it's flushing into this area through this high noted area here, this 2-day profile, I guess, this area right here. As it's flushing into this really, really, really fast. You know, I'm looking to get paid, flushing into the profile as much as you can get. Put your limit orders down there and see if they get filled. So I put my limit order right in front of these 2 little zones right here, which was 79.69. And I got filled on that second sweep right over here. And after that, it bounced and chopped for another 5-10 minutes or so. And then, well, after that, the day is, you know, chopped. Last thing I want to say is that arguably, maybe I could have held it and stuck around the trade longer. But is it really worth the time and energy looking at the market for this extra hour or 2 hours just to get, you know, maybe 10 or 20 or 30 more ticks out of it? I would say absolutely not. I have better things to do with my day. And, you know, that was the trade, in my opinion. That was pretty much the bulk of the trade. You know, shorting it off that weekly level 82s, you know, fade it back to the $80 even number and give it a little more if you can. And that may as well be the top. Maybe we're going to go down to $70. I don't really know if that's going to be the top. I'm not really playing for those types of trades. That's going to be it for this video, guys. Thank you for watching. Click here if you want to learn more about Sierra chart and some of the basic settings that it has. And then click here to watch a playlist of other videos like this. Thank you so much, and I'll see you in the next one. Take care.